Welcome back to Investing Top Podcasts.
Today we're looking at stock.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis.
Okay, let's unpack this one. I mean, when you just look at the raw numbers, the performance here it's pretty staggering.
It really is. It's not just growth, it's what you'd call hyper-growth.
So where do we even begin with the financials? The top line.
Yeah, I think you have to start with the top line, right? I mean, that's the headline number. For Q3 2025, revenue hit $585 million.
And the growth rate on that was?
A massive 68% year over year.
68%. For a company of this size, that's just judgeable. It suggests they're really hitting an acceleration phase. What's actually fueling that?
It's the advertising. That's the core engine. The company is, fundamentally an ad platform, and that ad revenue surged 74% year over year.
So the main revenue stream is growing even faster than the company as a whole.
Exactly, which is a huge sign of health. And it's not just a one-off thing. They've been consistently crushing expectations.
Right, I saw that this was the 5th quarter in a row for an earnings beat.
5 in a row. The Q3 EPS was $0.80. The street was only expecting 52 cents. So analysts are, they're clearly still trying to catch up to how fast this thing is moving.
Okay, but usually that kind of growth, it comes at a huge cost, right? You see companies just burn in cash on marketing to get that market share. Is that what's happening here?
And that's where the story gets really, really compelling. Because no, they're not. They're achieving profitability and elite-level leverage at the same time. The gross margins are sitting between 90.8% and 91.2%.
90%. Okay, just for the listener, break that down. What does a 91% gross margin actually mean?
It means they're running an incredibly capital-light business. Once the platform is built, every new dollar of revenue costs them next to nothing to deliver. It's almost pure software profit.
That's the top level. But what about when you factor in operating costs? R&D, payroll, that kind of thing?
Even there, the adjusted EBITDA margin expanded to 40.3% in Q3. But the number you really need to look at is the incremental adjusted EBITDA margin. That hit 58%.
Okay, let's pause on that. 58% incremental margin. That sounds technical, but it feels really important.
It's critical. Think of it this way. For every new dollar of revenue they're bringing in, 58 cents of it is flowing directly to their adjusted profit. It just shows how incredibly efficient their growth is now.
So they don't have to hire a whole new team or build a new data center every time sales jump. The existing machine just handles it.
The machine handles it, and it gets more efficient as it gets bigger. And the balance sheet just confirms this whole story. They've got $734 million in cash, another $1.33 billion in short-term investments, and zero debt.
Zero debt. That's a fortress.
It's a fortress. And it's all self-funded. They generated over $500 million in free cash flow in the last year with almost no CapEx. They're a cash-generating machine.
So the financial engine is clearly top tier. Let's talk about the fuel. What's the foundation of the business that makes all this possible? The users, the moat?
It all comes back to the community. Daily active uniques, the DAUQ, they grew 19% year over year to 116 million. Which is, very healthy user growth.
But here's the thing that really stands out to me. Usually when you try to squeeze more money out of each user, you risk alienating them, right? Your user growth slows or even shrinks.
And that's the magic trick here. They grew users by 19% while growing the average revenue per unique, or ARPU, by a stunning 41% to over $5.
So they're getting more users and getting much, much more money from each one all at the same time.
Exactly. That tells you the platform itself is becoming more valuable to everyone involved, both the users and the advertisers. It's not just ad fatigue.
Which brings us to the moat. I mean, the ad market is so crowded. You've got Google, Meta, all these giants. What is their unique angle?
Their moat is all about intent. On a normal social feed, you're just passively scrolling. Here, people show up with a purpose. They're asking specific questions, researching a purchase, looking for answers.
So it's less social media and more, like a specialized search engine.
It's much closer to search intent than a social feed. And that intent-rich content is incredibly valuable. Advertisers will pay a huge premium because the targeting is just so much better.
And that high-value data, that leads us to the next big driver, right? The AI angle.
This is where things get really interesting for the long term. That whole library of questions and answers, the discussion graph, is an absolute goldmine for training AI models.
So they're not just selling ads anymore. They're becoming, what, like a data provider?
They're becoming a knowledge infrastructure provider. And there's already a lot of market chatter, analyst notes pointing to data licensing deals. It's an emerging revenue stream that is basically pure profit.
It's a huge hedge then. If the ad market gets choppy, they have this completely different high-margin business to lean on.
It's massive optionality. They're building a data moat that even the biggest players can't easily replicate.
Okay, let's shift gears a bit. Let's talk about market perception and some of the things that might make investors nervous, like insider selling. We saw some of that recently.
We did. And you're right, it's something to watch. We saw the CTO plan some sales. The COO sold about $20.1 million worth.
Yeah.
On the surface, that can look scary.
So why shouldn't we see that as a red flag?
Well, the context is key.
Yeah.
These are widely seen as routine, scheduled sales for diversification. You know, when a stock runs up this much, executives are often expected to trim their holdings. The COO, for example, he still holds over 1.18 million shares directly.
So it's a small trim, not an exit.
Exactly.
Yeah.
And while the insiders are trimming a little, the big institutions are doing the exact opposite. They're buying in aggressively.
Okay, so who's buying?
We're seeing major accumulation. Vanguard upped its stake by over 71%, and Nordea Investment Management, they increased their holding by, get this, over 21,000%. They have a $164 million stake now.
Wow. When you see the big, sophisticated money moving in like that, it's a huge vote of confidence.
It is, and the technicals back it up. The stock is in a clear uptrend, holding above key moving averages. That $190 to $200 level has been really solid support.
So what are the key dates we should be watching over the next, say, 3 months?
All right, so on the calendar, you've got the big ETF rebalancing on December 18th. Then the 13F filings are due January 29th, which will show us just how much institutions bought in Q4.
But the real main event is in February, right, with earnings?
That's the big one. Q4 earnings are on February 13th, followed by their Investor Day and Q1 guidance on the 25th. And they've already guided Q4 revenue higher than the street was expecting, so the bar's already set pretty high.
Okay, so we've laid out a pretty strong bull case. Let's be balanced and talk about the risks. What's the bear case here?
The first one that's been getting headlines is a legal investigation, something about declining users.
Right, I've seen that.
This seems fundamentally mispriced. The claims are based on some really old analyst comments. When you look at the company's actual reported numbers, what do they show?
19 to 21% user growth.
Exactly. The actual data directly contradicts the fear. So as long as they keep reporting strong user growth, that particular risk should just fade away.
What about the second risk? And this one feels more real to me. Valuation. The stock is not cheap.
No, it's definitely not cheap. The PE multiple is up around 172x. That's an eye-watering number for a lot of people.
So how do you possibly justify paying 172 times earnings for anything?
You justify it with that operating leverage we talked about, that 58% incremental margin. The argument is that the E in PE, the earnings, is about to explode higher so quickly that the multiple will come down to earth really fast.
So you're paying a premium today for the incredibly efficient profit growth that's coming tomorrow.
That's the bet. That and the fact that they're still guiding for 50% plus growth.
And the final risk, just pure execution.
That's it. You know, while gross margins are great, their pre-tax margin was actually negative in Q3 because they're investing so heavily in AI and international growth. The risk is that those investments don't pay off. Management just has to execute. If they stumble, a high valuation stock has no safety net.
This has been a fantastic breakdown. To wrap this all up, what's the one big idea you'd leave with the listener?
I think it's this. The combination of that explosive ad growth, 74%, with the structural advantage of their AI data moat. It fundamentally changes how you could think about valuing this company. The question isn't just can they grow, the real question is should this be valued like a media company or should it be valued like a piece of critical knowledge infrastructure for the future of AI?
And if the market decides it's the latter...
If it decides it's the latter, then even at today's price, it might still be significantly undervalued in the long run.
A brilliant way to frame it. If you enjoyed this analysis and want to stay on top of our latest takes on the market, make sure you hit that subscribe button. We'll see you next time.